Evening all. I welcome all of you to the Sky High Symposium Series 15. And on behalf of the Institute of Chartered Accountants of India, Women Members Empowerment Committee, we heartily welcome all of our endeavor to serve the best for the members of our institute and particularly the women fraternity at this committee. And I'm very happy to start this 15 series. Friends, since last 15 Wednesday, we are meeting each other. And today we have two faculties with us. One is on estate and succession planning, CA Toral Shah, and she is basically from Mumbai. And Toral madam, welcome to you. And we have CA Subhashini Ganpati from South, and she will be taking us through the non-profit organizations, various statutory obligations. Friends, today I am at Delhi, and we have Board of Studies meeting. So we are going through this new scheme of education and training where we had this in principle approval from the Ministry of Corporate Affairs about this new system of education and training. We have done more than 100 outreach meetings across India and had the feedback form where we have received around 25,000 feedbacks from various and stakeholders. We have compiled this and we had threadbare discussions for 2 days, yesterday and today, in this board of study meeting where majority of the council members were present. And again, after compiling this overall feedbacks and the views from all these 25,000 members, we have threadbare discussion. We will be now going to, it will be going through the council meeting, it will be passed, again it will be presented to Ministry of Corporate Affairs, and it will be approved by Government of India, and this new system will come into the picture maybe within next 5 to 6 months. There are a lot of other things as regards to I am chairing other than this WMEC sustainability reporting standard board as a vice chairperson. Our social stock exchange notification for zero coupon zero principal bond has been approved by SEBI, and we have been given the task of developing social audit standards, and which we are developing it. We have drafted the social audit framework and given to SEBI. SEBI has given the comments and we will be approving in the council. We are also developing audit standards and again it will be approved by SEBI. We are planning various ESG talk shows and various roundtable meetings. So if all of you, any of you are interested in taking any of the sessions on ESG Sorry, friends, for some technical issues. Once again, I welcome all of you, and I must appreciate the efforts of our entire office of WMEC with Shanu, who is in charge of WMEC and doing a lot of work. We are also coming up with GST Setu program. So we are planning to have recorded sessions on GST. So if anyone wants to practice GST, they can go through these videos. So maybe within next 15 to 20 days, this GST series on recordings on Setu series will be uploaded and will be circulated, and it will be practical training program on GST. It will be some around 20 hours training program, recorded video, recorded training program on GST. After GST, we will be also coming up with various other topics like TDS, income tax, and also audit standards on auditing, Indies. So these are our future plans. So stay connected with us. With these words, once again, I welcome all of you, and over to my dear coordinators.
Good evening, one and all. Good evening, Preeti ma'am. First of all, many congratulations to all of us for doing this Women Empowerment Committee program throughout. It is 15th, we all know very well. So it's hats off to all of us actually. We must congratulate each other for this thing. So a very good initiative and very remarkable thing you are doing, and we are supporting that. I'm here to, first of all, my introduction, myself, Seema Baheti from Akola. I am currently heading Vikasa Akola, Vice Chairperson at branch. I'm here for Toral ma'am. Toral ma'am introduction I'm going to give. Toral ma'am is a partner of the firm with 22 years of experience. Toral ma'am specializes in transaction and business structuring, direct tax advisory and representations, as also estate and succession planning. As we all know, today's her topic is only that succession and estate planning. She also heads the transfer pricing practice at GBCA. She is a regular contributor to professional journals and member of the journal committee of the Chamber of Tax Consultant. By this, I congratulate ma'am and thank you for joining us, Toral ma'am. I hand over the charge to ma'am.
Thank you, Seema, for the kind introduction. Good evening, Preetibin, and thank you to the WMEC committee for giving me this opportunity to share my views on succession planning with all our women co-professionals. So while I will share my presentation, but I want to start with this note that we all as professionals are very busy with our own professional lives, of course, doubling up with our personal responsibilities at our home as well. So today's topic is not just for us as professionals, but it is for us at a personal level also to pay attention to our own families and our own selves for succession planning. And with this starting remark, I will start with the presentation. The intention of the presentation is to discuss what are the needs for succession planning. Second, what are the hurdles that we face? Why we all feel that succession planning, making of a will is a necessity. What are the hurdles that we normally face while actually carrying out the activity? We all as professionals also are very enlightened and we know, yes, everybody should have a will. If I were to actually have a raise of hands, 90% of us also have not made a will. So the question is why we are not doing it. So today, the whole intention is to create that awareness in our own selves. With that, we will also do what is required for our personal lives. And also with that enlightenment, we will also be better consultants to our clients, not just for taxation and audit and other areas of business, but also guide them on their own succession planning. So with this, I will start my presentation on succession planning. And I hope I'm audible. Thank you. Okay. Just a minute. So now the first question is, why do we not make a will? So succession, first step in the succession planning for any individual is to make a will for himself or herself. Yeah. Just a minute. Is it visible? Okay. So now, while we all have in our minds the thought that yes, making of a will is a necessity, why is it that most of us are not making a will? So while we have tried to analyze the reasons that are the hurdles in making a will, because unless we understand the thoughts that are stopping us from doing what is required, we will not be able to take the next step. So first thought is only will is required to be made only by rich people, which is a myth. Anybody who has some assets, even if you have a FD of 20 lakhs or 10 lakhs rupees, you should make a will. We will discuss what is the need why we should make a will. Even if you have small wealth which you want to pass on seamlessly to your family. Second is death is not a pleasant thought. When you are making a will, you have to start thinking, when I die, what will I do with my wealth? Whom will I give it to? So this is not something which is pleasant thought. Even our family stops us from thinking, what is the need? We are still young. So that is the reason why that is the second hurdle. Third is, while we professionals will not think of it as a fear of losing control of assets, people who are not as educated or who may not have too much background always feel that if I make a will the assets go away from my hand? Will I lose control? So for such non-professionals, maybe this also is the reason why they avoid or shy away from this topic. Avoiding awkward family discussions. So when you start this process, there are topics of what I should give to my daughter, whether I should give anything to my married son, whom should I give more or less. So these are unpleasant or awkward questions which come up in the family. So we normally tend to avoid those discussions. Then hesitancy in sharing private wealth data with consultants. So this is true for others. We can make our own wills. We are equipped to do that. But when it comes to others, maybe they are not very keen to share their financial data with professionals, whom they will have to go to make their will. Third is there is a myth that it is expensive and complicated. General public is of the belief that it is a complicated process. I'll have to pay a lot of fees, which is again a myth because it is not a very expensive and complicated process. And third is to tendency to procrastinate at it is not time bound. Like us all professionals, most of us will file 60% of our returns in the last week of the July month. Because there is a deadline, we will definitely upload all our returns by 31st July. But because there is no deadline or there is no visible deadline to our own life, we don't know what is the end date. So we keep procrastinating this work of making our own will. So these are some of the reasons which stop us from making a will. So we need to overcome all these hurdles and then start the process of acting in that direction. So why is succession planning an important activity which we all need to do? First and foremost, uncertainty of life. COVID has actually shown us that in the last 2.5 years, we have realized that there is no right age, there is no wrong age. Life can be so uncertain. So uncertainty of a life, while we all know about it, we have seen it very closely in the last 2.5 years. That is the reason why the moment you have some wealth which you wish to pass on to your family, your loved ones, there is no right time. This is the right time to make a will. Avoid litigation. So if you do not leave a will or a document behind, there is a very high probability that after you, there could be litigations amongst your children, your family members, because there is no clarity on what you wish to do with your wealth. It is not documented and it is not known to them. So if you want to avoid litigation, you should definitely make a will. Smooth transition of assets. So when we must have all witnessed this while we are dealing with our clients' own cases. In the absence of a will, it is such a task to make the banks, the mutual fund agencies, the depositories to transfer the assets to the legal heirs, to the nominees. There is so much of confusion about who has a right, the nominee or the legal heir or the joint holder. So all these uncertainties come into the picture. Your own family has to run from pillar to post just to get the wealth that you have amassed with so much love in the hope that they will be able to enjoy it. So for smooth transition of assets, it is very important that there is a will which is clearly laying out the succession. Controlling the end use of wealth. So by making a will, you are ensuring that the wealth that you have accumulated, the thoughts that you have had in your mind, the wealth is utilized for the purpose with which you have accumulated it. For example, if you wish to donate some money, you can write it in your will if you have not been able to do it during your lifetime, that I wish to use that 10% of my money should be used for charitable purposes. If you have a child which is a special child, you can keep it separately, a kitty for him, so that he or she is taken care of in your absence. So all those special objectives that you wish to achieve can be achieved, and your end use of the wealth can be controlled by putting it down in the will. Opaque succession laws. So we are focusing today more on the Hindu succession laws. So Hindu succession has its own sequence of how the wealth will pass if there is no will. There is a lot of ambiguity even within that. The Hindu Succession Act is also a complicated act. So if you want things to be very clear after you, it is important that you document it. Estate duty, inheritance tax. So succession mein one part is will, the other part is making a private trust. When we discuss about private trust, we can discuss how you can also circumvent inheritance tax laws, or to some extent you can plan that not substantial part of your wealth will go towards inheritance taxes if it ever comes. You can plan it during your lifetime. So this is the reason why you should go ahead and do your succession planning. So while succession planning is of your personal wealth, unless there is clarity, especially when there are business families, there is clarity amongst the business succession, ownership of the business assets. Unless that is clarified well in time, your personal succession planning is not going to be easy. For example, there are certain hurdles in your succession planning if there is no business planning. And what are the hurdles when you talk about business succession planning? Normally, there is a patriarch of the family, and all the other members working in the family follow whatever instructions coming from top down. So nobody is willing to go and talk to the patriarch. What is the thought process? How are the business assets intended to be distributed? Then there is generally, we have seen, especially in Gujarati Kutchi families, while the business is common, everybody is pulling out resources from the common pool of wealth. There is total lack of clarity on what is the asset sharing ratio, what is the profit sharing ratio, whether the remuneration that is being given to different family members is proper or not. There is no entry strategy, no exit strategy, who should get a profit share, who should only get remuneration. There is no discipline on personal withdrawals. And then there is a lot of lack of communication amongst family members. So nobody is questioning, while internally they may be feeling one person is using more of family wealth for his personal benefit. One person is getting more than what he is contributing. But there is lack of communication, which has a lot of pent up emotions inside. Then, and we have also seen that the assets of the families are not held in a very organized manner. So say if there is a family of 4 brothers who down the line have 8 children, there may be some assets which are held in the name of one of the child or 2 of the children. One asset which is held in the name of 4 brothers. The intention of the sharing is different, but the legal holding the assets is very different. This also leads to a lot of confusion. And in the process, unless that is streamlined, you cannot do a succession planning of your personal wealth. So untangling the business assets, especially where there is a joint family business, is so critical to move to the next level of your own personal wealth planning. This is very important because In your will, you will only be able to write about assets that you own in your own name, your own legally owned assets. What is a mutual understanding between the family members cannot enter your will. That is the very important reason why business clarity of succession has to precede a personal succession planning. One more untangling, if you may say so, required is at the HUF level. So historically, HUF was seen as a very good tax planning structure. You have big families who have done businesses in HUFs. They have amassed so much of wealth in the HUF. Over the years, when 2 to 3 generations of family members have joined the HUF as co-partner, because it is automatic by birth, then that is the time when you realize that having wealth in an HUF becomes a very litigative entity. There is a lot of confusion on what are the rights of the co-partners, what are the rights of the members. So we have always been suggesting that HUFs have to be untangled. HUFs have outlived their utility. They were just for tax planning when the tax rates were very high. Now it has become inconsequential. Earlier, there used to be joint families, there was joint living. Now, increasingly, families have become nuclear. So, keeping the wealth in HUF, which is a huge joint family, when the families are themselves nuclear, is a contradictory, scenario. HUF Hindu Succession Act is which itself very complex. HUF as an entity is very complex, and the mixture makes it more complex. So, this is why we feel it's time for HUFs to untangle. Also because of the amendment in the succession laws relating to daughters. Now, the fact is that married daughters have higher rights than their own mothers and daughter-in-laws of the family in the HUF properties, which may not be intended, which has come because of the change in law. So these are some reasons why we advise that HUF partition is also a very important step if a family wants to go ahead for its succession planning. So now we will discuss on what are the modes of succession planning. While there are 2 ways in which you can plan for the succession of wealth. 1, during your lifetime. 2, after you are not there. So generally for people with a nominal amount of wealth or who are not falling in the HNI or very HNI category, making a will meet the prerequisite of succession planning. For HNIs or very high net worth individuals, trust is a very important tool for succession planning. Today we will start off with the first step where we are talking of transfer after death. In that there are 2 scenarios. 1, what if you don't make a will? What happens to your wealth if you die without making your will? Understanding this is so important and critical for us to appreciate why we should make a will. And the second is will, where we will discuss what are the legalities of a will, what are the constituents of a will, what are the steps necessary when you are actually sitting down to make a will. And then we will also touch upon trust as a structure, the tax provisions, the Indian Trust Act provisions in brief. Here we are going to discuss the Hindu Succession Act 1956, where what happens when there is an intestate succession. In case of a testamentary succession, Indian Succession Act applies. And there is, for Christians, Parsis and Jews, the Indian Succession Act applies. The Hindu Succession Act applies to Hindus, Jains, Sikhs, and Buddhists. So we will discuss what happens when a Hindu or a Jain or a Sikh or a Buddhist does not make a will, and his assets will pass on as interstate succession to his legal heirs. So normally, I would believe, or most of us think that way, that if we are married, we would normally want that the wealth should pass on to the husband. And after the husband, our children should enjoy the wealth. But does this objective get achieved if you don't make a will? So now let us look at what does the Hindu Succession Act say. Hindu Succession Act says that if you do not make a will, under the law, we have written down how your wealth will pass on to your legal heirs. And it will only follow that sequence and no other. If you want that the sequence should not be as per the law, you will have to make a will. So what is the sequence the Hindu Succession Act will follow if you have not made a will? There are different categories for Hindu male and Hindu female, Hindu male married and unmarried, Hindu male female married and unmarried. There is a very well-defined sequence of succession. So we will talk about Hindu married male first. So if a Hindu married male does not make his will and he leaves behind, say, a sum of 10 lakhs rupees, how will this 10 lakhs get distributed? So first, class 1 heirs will get the 10 lakhs rupees. Now, who are the class 1 heirs of a Hindu male? They are his mother, his wife, and his children. Here in my example, I have considered one daughter and one son. If they are more, then all of them will be part in the first line itself. That means in this example, the 10 lakhs rupees will get distributed between his mother, wife, daughter, and son equally. So each one will get 2,50,000 each, 2,50,000 rupees each. What if the son has predeceased? He has a son who has died, and the son has left behind a widow and or children. Then the deceased son's family will step into his shoes, and they will get 2,50,000 rupees. And similarly, if the daughter has predeceased, the daughter's children, not the husband, will step into the shoes of the daughter, and they will get the 2,50,000 rupees that the daughter was entitled to get. This is the class 1 heirs of the Hindu married male with wife and children and mother, surviving mother. Now, here it is very important to note father is nowhere coming into the picture because father is not a class 1 heir. So if, for example, the Hindu male married had a father and his mother had already passed away before him, then the 10 lakhs rupees would get distributed only between his wife, daughter, and son. Each one would have got 1/3, 1/3, 1/3, and father would not have got a single rupee. This is the class 1 heir of Hindu married male. Now, if the Hindu male was unmarried, then his wealth would go to his mother, who would be the class 1 heir, because there would be no wife and no children. Now, what if the Hindu married male did not have the first class 1 heirs at all? Now, we will check who are the class 2 heirs of a Hindu married male. So, class 2 heirs of a Hindu male. Now, this would be true even if he was unmarried because there are no wife and children who are surviving him. So, then in this case, the sequence will be as per this steps. First, he has no mother, he has no wife, he has no children. So now if his father was surviving, then all his 10 lakhs rupees would have gone to his father. No other person would have got that money. Had the father not been alive, then the assets would have gone to his sons, daughters, children, brothers, and sisters. Now, this is now the sequence one after the other. If father is not there, then the second level will come into picture. They will take the money, 10 lakhs rupees. Even if there is no second level, then you see who is the third level. Then the daughter's grandchildren would have come into the picture and so on. In the absence of the sequence, the next sequence will get the money and they will share equally. That class will share equally. This is how the bequest will happen in case of a Hindu male class 2 beneficiaries, where there are no class 1 beneficiaries. Now we talk about what happens if there is a Hindu female who is married. In case of a Hindu married female who has a husband and children, in our example has a son and a daughter, all the assets of the Hindu married female will go to 3 of these people equally. So in our example, if 10 lakhs rupees are left behind by the Hindu married female, her husband will get 1/3, daughter will get 1/3, son will get 1/3. If any of her children have predeceased her, then in case of a son, the son's wife and children will get 1/3. If daughter has children, her daughter's children, if she has predeceased, the daughter's children will enter her shoes. They will get 1/3 share of the 10 lakhs rupees. These are the class 1 heirs of a Hindu female married. Now, what if the married female does not have any of their survivors? If she does not have children and her husband has already predeceased her, then who are the class 2 heirs? Who will take her 10 lakhs rupees? Then, in that case, very important, all her wealth will go to the heirs of her husband. Here it is important to note that heirs of the husbands will again be all those people whom we spoke about here. Father of the husband, if he's not there, son, daughters, brothers, sisters of the husband, if they are not there, then this sequence will follow. If none of the husband's heirs are present, only then her wealth will go to her parents. And if her parents are also not surviving, then upon the heirs of her father, which again will go to the married, same sequence as a married male. And if none of the family members of her father are present, only then it will go to the heirs of her mother. So very important to note, everything first goes to the husband side of the family. If no one is there in the husband side of the family, only then it goes to her parents' side of the family. One differentiating factor here is, if a woman had inherited something from her father, then that part of her inherited assets will first go to her father's side of the family when there is no class 1 heir. If there are class 1 heirs, first they will take everything. However, if there are no class 1 heirs, then her property will be broken up into 2 parts. One part, which is what she got or inherited from her father, that will go to her father's side of the family. And what she had her own self-earned assets, or what she might have got from her husband or husband's side of the family, all those assets will then follow this sequence. So this is how it will go in case of a married, unmarried Hindu also, or a married Hindu who doesn't have class 1 heirs. Now, I think with this discussion, there is a lot of clarity on why we should make a will. The intention may not be to give equally to the husband and children. The intention may not be of a married woman who has a predeceased husband that all her wealth should go to the father's side of the family. There may be intention that if I am not married, I may want to donate a substantial part of my wealth, which will not happen at all if I don't make a will. Having discussed all the requirements of why I should be making a will, we will come to what is a will, what are the constituents of a will, and what all care you need to take while you are making a will. So why should you make a will? I think we have sufficiently discussed. You can decide how your estate will go. You reduce family conflicts. You can provide for charity. Now, very interesting point that is which can be achieved by making a will is you can give life interest in a property through a will. Say, for example, you have a house property. You have a mother. And you want that your mother should be able to stay in the house, and only after that, your son should get the property. So in that case, you will write in your will that I give life interest in the property to my mother, and after my mother, the property will go to the son. This will ensure that you will secure a house for your mother during her lifetime if you predecease her, but eventually the property will go to your son for whom you want to keep the property. This can be achieved by making a will. If you do not make a will, the property will directly go to the son and you will not be able to ensure that the security of home of your mother is taken care of. Similarly, conditional bequests. Conditional bequests meaning if, say, I have a house property, I am giving the house property to my son, I am giving some other assets to my daughter, there is a housing loan of say 10 lakhs rupees which remains unpaid when I am not there. I want that whoever gets the house should take the liability of the housing loan. This will happen only when I write all that in the will and say that I'm giving my house to the son, and any housing loan which is unpaid at the time of my demise should be tied to whoever is taking the property. In this way, you will ensure that the liability does not come back to somebody who is not getting the asset. So for achieving all these objectives, it is very important that you make a will. So what are the constituents or important aspects of a will? When you are making a will, what all decisions you will need to take? One, you will have to appoint executors or managers or trustees of your will. So who are the executors? Executors are the people whom you will name as executors and who will be responsible for ensuring that all your assets are distributed and dealt with in the same manner as you have mentioned in your will. So who should be the executors of your will? Your executors of the will should be preferably people who are younger than you, so that they will be there when you are not there. They will be able to do the running around when you are not there. You can also appoint professionals as executors. So normally we would appoint, say, a wife is making her will, we will appoint the husband as one of the executor, maybe the son also as executor. If you are envisaging any disputes amongst your family members, you may want a professional to be an executor to be of the trust will. So while taking decision on executors, these are some of the points that you will have to keep in mind. Now coming to what are the things that you will need to identify. You will have to identify whom you want to make beneficiaries of the will and what you want to give each of them. This will depend on the family dynamics, the financial condition of your family members, any special needs of your family members, your desire to give any non-family member, maybe a maid or some domestic help who has taken care of you, any needy distant relative, any charity that is very close to your heart. So these are the beneficiaries you will have to identify and decide what you want to give to whom. Thirdly, you will have to identify two witnesses. For a will to be valid, it has to be signed by the person whose will it is, and it has to be witnessed by two witnesses. So who should be witnesses again? So again, witnesses should be people who are younger than you, who will be there, who are close family members preferably, or if there are challenges with health of the person making the will, you can also have a doctor become a witness so that at later point of time, nobody challenges the will on the ground that the person making the will was not in the right state of health or mental health when he or she was making the will. So you'll have to identify who will be witness to your will. You will take a decision on whether you want to register your will or you do not wish to register your will. Now, the question is it compulsory? So the answer is no. A will is valid if it is written on a plain paper, signed by the maker and witnessed by two witnesses. It doesn't have to be on a stamp paper. It doesn't need to get registered. Then why registration? So normally what we advise is if there are disputes in the family where there is a probability that the beneficiaries or family members who are not given equally along with others will challenge the will on its ground of being invalid or having been made under coercion. That is the point, or those are the cases which can opt for registration. And other cases who could go for registration is where the wealth is very, very substantial. You want to be very clear. There is no challenging. There is no ambiguity. Everything is seamless after you are not there. Then you go for registration. In normal circumstances, registration is not something we should be doing or advising anybody to do. Now, when you are identifying beneficiaries, we also identify alternate beneficiaries. Now, what are these alternate beneficiaries? Say, for example, you are making your will. In your will, you are writing, my immobile house property, residential house property, I wish to give to my husband. If you stop at that, and for some unfortunate reason, you and your husband happen to travel together and meet with an accident, what will happen to the house property which you have left for your husband? Whom will it go to? Again, it will be open. If you had intended it only for your son, it will not happen that way. It will go both to your son and daughter. Or if you wanted to give it only to one son and there are two sons, again, it will go equally to both the sons, which was not the intention. So normally we suggest that when you are identifying the primary beneficiary, say in this case, you had identified your husband as the primary beneficiary, that the house should go to your husband. But you should also identify a alternative beneficiary. So you will say that if my husband also is not present when I am not there, then the house property should go to my elder son or younger son. So for all classes of assets, we suggest and recommend that you should always have alternate beneficiaries. The reason being that when an event happens and you do not get a chance, you may have made person A a beneficiary. Person A is no longer there. He predeceases you, but you do not get the opportunity to revise your own will. In that case, if the alternate beneficiaries have already been identified, then there is a lot of clarity on the succession of your assets. So preferably, if possible, you should always identify not only the primary beneficiaries, but also who will be the beneficiaries if the primary beneficiary is not present or predeceases you. And third is last important clause is the residuary clause. Residuary clause is when you are making a will, you make a will on a given date. Say today I am making my will. I have certain assets, immovable properties, bank balances, shares. But my assets composition is a continuously changing mix. Every day I'm not going to change my will. I'll make a will. I will not revisit it unless there is an event. There is a change I want to make in executor. There is a change I want to make in a beneficiary. Or there is a substantial change in the assets that I'm holding. That is why this residuary clause is very important. So residuary clause is the clause which says that if I am holding any other asset, which are other than what I have already described above. So a will normally say my immovable properties are so and so. It will go to these people. My shares are held in this demat accounts. It will go to these people. But if I have any other assets which are not described above, whom should those assets go to? So you may say all my residuary assets should be distributed to my husband and children in equal proportion. Or I want to give it to my husband exclusively. So residuary clauses are important. Otherwise, what will happen? Wherever you have made specific bequest, it will go as per the specific bequest. And what you have not specifically mentioned will again go back as per the Hindu Succession Act. And the class 1 beneficiaries will get the assets or the class 2 beneficiaries will get the assets depending on the facts at that point of time. So it is very important to also mention the residuary clause in your will. After having made a will, what are the post-formation actions that you need to take or things that you need to know? Like for example, once you have made a will, it is very important that you align your joint holding and nominations as per your will. I'll give an example. Again, coming back to the residential property, you want to make your husband as the beneficiary after you're not there. But in the society, you have nominated your son as the beneficiary, as the nominee. Now, this nomination conflict has in fact given rise to so many case laws, judicial decisions, because people have gone to court. Nominee has made claim that because I am the nominee, now I am the owner of the asset. And joint holder, if there is a joint holder, he ends up getting the full property and he claims that I am the sole joint holder now because the will is saying somebody else as a joint holder. So it is very important that nomination at least should be in sync with what you want as per the will. So if you have made your husband the beneficiary in the will, ensure that the nomination is also in his favor. Otherwise, while the law has now been made clear by various case laws, that nominee is not becoming the beneficiary. Nominee is only a trustee. The role of a nominee is that whoever the agency is, say for example, a demat, a depository, a bank, or a society where you hold a flat, they should have clarity whom they have to deal with in your absence. The nominee is only the person to enable that these agencies can deal with somebody in your absence. So he will hold the property or assets only as a trustee. But all the assets will have to be given back to all those people whom you have mentioned in the will. So, while the law is very clear, to avoid any kind of conflict between the nominee and the beneficiary, it is always advisable that your nomination is in sync with your will, the beneficiaries in your will. Now, what is probate? We have come across this term when we are also dealing with our clients' matters. Question is a probate of the will required? What is a probate? Probate is a process by which the High Court of the jurisdiction which was governing the person who has died will stamp the will as the final will of the beneficiary, will say that, okay, the beneficiaries are the ones who are mentioned in this will. The will is the authentic will of the person who has died. And once that is done by the court, nobody can challenge that will later on. So during the process of the probate proceedings, the court will give opportunity to stakeholders to claim that, yes, I am also a legal heir, I should get a share in the property. All those claims will be handled by the court. After that, the court will come out with a probated will, copy of the will, and say, okay, these are the beneficiaries, these are the executors, and this is how the wealth of the deceased has to be handed over to the beneficiaries. So that will ensure that the assets are passing on seamlessly without any challenge. The question is a probate compulsory? Because it is a time-consuming process and also there is a cost involved. So if there are in the state of Maharashtra, Bombay, in the city of Bombay, state of Madras and Calcutta, if you are holding immobile properties in these states, it is important that your will is probated, because in the absence of a probated will, immobile properties cannot be transferred in these three states. Our practical experience is that, say for example, the person who died has legal heirs who are staying outside India, in US. So I want to open an account of the estate of the deceased, and I want to transfer funds from the estate of the bank account of the estate to her daughter who is staying in US. Practically, no bank is agreeing to open an account of the estate unless I give them a probated copy of the will. So although there are no immobile properties in Mumbai or anywhere else in India, still I am forced to take a probate, because otherwise the estate's account will not be obtained and I will not be able to remit any money out of India as per the will of the deceased. So there are these practical challenges also which make the probate of a will compulsory. And important to note that when I am transferring asset to non-family members through a will, there is no taxation, because 56(2)(10) gives me a clear exemption that any succession which is happening through a will, or any transfer or gift which is happening through a will, is tax-free in the hands of the receiver. Say I'm leaving 1 lakh rupees for domestic help, she will not have to pay any tax on the 50,000 rupees because she's getting it under a will. Similarly, I can leave it for extended relatives who do not fall within the definition of relatives under 56(2)(10), and there will be no tax impact for the receiver. Similarly, stamp duty exemption. When I'm transferring any immobile properties through a will to anybody, the transition is without payment of any stamp duty. So there is no cost of income tax or no cost of stamp duty when transfers are happening through a will. So we have understood all the important aspects while making a will. So before we move on to private trusts, one point which is also important is you should list out, when you're starting to make a will, you have to ensure that you're listing out all the assets that you're holding at the time of making the will, and ensure that for every item you are making a mention in the will and making a clear bequest to the beneficiaries. So you can say, I hold immobile properties, so and so. I own jewelry. I own shares in demat account, so and so. I have fixed deposits in banks. I have a bank locker. And then you define beneficiary for each of these assets. This will ensure seamless transition of every asset class that you're holding to your legal heirs as per your desire that you have mentioned in the will. So this was all about how succession can happen through a will. I understand we have some 5 to 7 minutes left, right? So I'll quickly go through the private trust segment. So why should anybody make a private trust? So as I spoke earlier, private trust is not meant for everybody. Private trust is preferable for people who have very high net wealth and who can give away some part of their wealth during their own lifetime. So if say somebody has 100 crores of wealth, he may decide, okay, I don't mind parting with 25 crores during my lifetime and giving it in a trust. This will ensure that there is ease of transition, because during my lifetime, if I'm transferring something to a trust, nobody is going to question me. The depositories will immediately transfer the shares if I'm wanting to transfer to a trust by my signing the DP note. There is transfer of ownership, which is easy. Ring fencing of assets is an important objective which people try to achieve. What do we mean by this? So if a promoter of a listed company has wealth and he tends to give personal guarantees when the company is borrowing money, he has commercial risk which gets triggered. There are liabilities on directors under even the Companies Act. So how does he ensure that some part of wealth is immune to all these claims that may come up on him, which is likely because of the risks that are involved in a business? So what he can do is, some part of his wealth he can park in a trust. So when he transfers to a trust, he makes his family members the beneficiaries in the trust. He himself does not become the beneficiary. In this way, certain part of his wealth is immune to all the risk that he himself is taking in his commercial or business ventures. Estate tax planning is an important reason why a lot of HNIs, even outside of India, have transferred substantial part of their wealth into trust structures. Because if you transfer to trust, when estate duty is when, say, I left 10 crores to my family through will. If there was estate duty, earlier there was estate duty in India, which was as high as 97%. Today we don't have estate duty. So assuming there is estate duty which comes into India, which is say 20%, and there is no threshold limit, then on this 10 crores of rupees, first the estate duty of 20% will be taken away by the government, and only the balance 80% will get distributed to my family members. So HNIs are transferring substantial part of their wealth during their lifetime today, in the hope that when the estate duty comes, it will not touch the wealth which has already been transferred to a trust, which is for the benefit of the family. And by parking the money in the trust, you can control the end of use of the wealth. Now let me tell you how this is achieved, which is not possible in a trust. See, for example, you are holding shares you are promoter of a listed company. You are holding shares worth 100 crores in that listed company. You don't want to give control directly to your son and daughter. If you write it in your will that I want to give to my son and daughter 50-50, they will become sole controllers of that 50% wealth. But you don't want that. You want that some third party also has a say in how the shares are handled. What do? You can either make a trust during your lifetime and transfer shares during your lifetime, and trustees will manage the decision making in the trust, although your family members will be the beneficiaries. In this way, you ensure that the wealth is enjoyed by the family, but the decision making is still in control of a group of people who are the trustees of the trust. In this way, you ensure control of end use. You can also make a trust through your will. So in your will, you can write that this shares of listed company will go to a private family trust, which should be formed by the executors, and where my family members will be beneficiaries, and other terms and conditions can also be mentioned. So that is a trust through will, and you can also create a trust in your lifetime and then write in your will that this wealth will go to ABC private trust, which I have made during my lifetime. In this way, you ensure how your wealth is controlled even if you are not there. Thirdly, if it goes to a private trust during your lifetime, you avoid the probate process. And when it comes to confidentiality, there is some level of confidentiality in a trust, because when wealth has gone into trust, you don't go through the probate process. In probate, it becomes an open process, because there everything comes out in the open. Court gives out a notice. Everybody comes to know who are the beneficiaries, what is the distribution of the wealth that you have done. But in a trust structure, this is some private arrangement which you have already made during your lifetime. So it remains to some extent confidential. So what are the constituents of a trust? So there is a settler. Settler is the person who contributes the wealth into the trust. The trustees are people who are appointed to manage the trust. They don't have to be beneficiaries of the trust, but they are people whom you trust, whom you know will manage the assets in your absence. In your lifetime, you can also be beneficiary of the trust, and after you can define who will be the trustees of the trust. Who are the beneficiaries? The beneficiaries are the people whom you will mention as the beneficiaries and who will enjoy the wealth and income of the trust. In the trust is governed by its trust deed, where all the points of for how long the trust should run, how the money should be distributed, what the trust can invest in, what it cannot invest in. It is such a personalized document. You can write everything under the sun that you want to write. You can also say that my son will be a beneficiary only if he marries within my community. If he marries outside my community, he will become a debarred beneficiary and he will be removed from the benefit of the trust. So a lot of things can be controlled in your absence by the trust structure. So in trust, the most important document is a trust deed. The trust deed needs to be registered with the sub-registrar, and you will define all the objects of the trust and how it is going to be handled in your absence. So there are types of private trusts. There are revocable trusts and there are irrevocable trusts. Revocable trust is where the settler himself has a right to receive back the assets. We normally don't make revocable trust because in that case, the objective of ring fencing is not achieved. The objective of ensuring that estate duty liability does not come in case ever in future estate duty is introduced by the government. And thirdly, in case of a revocable trust, the tax liability again falls back on the settler. So these are the reasons why we normally don't make, but there are circumstances and objectives which are achieved by forming a revocable trust also. But in general, it is preferable to make irrevocable trusts. And on the basis of beneficiaries, there are two types of trusts. Specific trusts. Specific trusts are the one where you say, okay, I'm making this trust where my son will be 50% beneficiary and my daughter will be 50% beneficiary. Or you say that my wife, daughter, and son will be 1/3 beneficiaries. So you are specifying what is the benefit of the stakeholders. And a discretionary trust is something where you say all my wife and children are beneficiaries, and it is left to the discretion of the trustees to decide what they will distribute to each of the family members, depending on the needs of the family members, the objective with which the trust was created, and the desire of the settler, which he may communicate to the trustees by giving him a letter of wishes. So there are these types of trust: revocable, irrevocable, specific, and discretionary. So taxation, I think we will have to skip because I guess all of us are aware of how taxation of private discretionary trusts happens and what happens in case of private specific trusts. Here it is very important that 56(2)(10) has to be kept in mind. 56(2)(10) says that exemption is available only if trust is created for the benefit of relatives of the settler. So your relatives definition, you will have to go back to 56(7) definition of relatives. Say, for example, I want to make my brother's son as a beneficiary in the trust. I can't make, because if I do that, then the transfer that I make as a settler into the trust will become a taxable transfer. So if I contribute, say, 10 lakhs rupees into the trust, it will become taxable because in the hands of the trust, because my nephew is not a relative as per 56(2)(10) definition. Not my relative, it has to be relative of the settler. So from my point of view, my nephew is not a relative, although I am a relative for my nephew. This is very important distinction which has to be kept in mind when you are defining the beneficiaries in a private trust. So when you want to transfer immovable properties, there will be a stamp duty impact. So there is a cost if you want to transfer immovable properties during your lifetime into a private trust. So income, how it is taxed, specific trust, discretionary trust, and revocable trust. I will not get into the taxation of it. Distribution. So because the taxation happens at the trust level, there is no tax payable in the hands of the beneficiaries in the case of discretionary trust. In specific trust, the taxation happens in the hands of the beneficiaries and no tax is paid by the trust. And of course, there is no double taxation. So if either the trust has paid the tax, so not taxable in the hands of the beneficiary, or a specific beneficiary is paying tax, then there is no tax in the hands of the trust. There are other laws also which come into picture depending on the constitution. So if you have non-resident beneficiaries, you have to check the FEMA aspects. If you want to transfer shares of listed company where you are a promoter, you have to ensure that takeover code is not triggered. You are not transferring 5% or more. If you want to transfer more than 5%, you need to go to SEBI for approval. When you are making non-resident beneficiaries, you need to check what is the tax impact in the hands of that non-resident beneficiary in the resident other country. Even FEMA has restrictions on whether you need to go for permission to RBI when you are contributing to a trust, where a non-resident is a beneficiary. So as your constitution starts having residents, non-residents as beneficiaries and trustees, there are other laws also which have to be closely examined before you structure the trust. So key takeaways to conclude, I hope I have been able to convey the importance of doing succession planning for our own selves and also for educating our own clients to do their succession planning. How untangling of all the complex ownership structures is critical if you want to have a seamless succession planning. And making a will today is not the end. You will have to ensure that you review it, revisit it when there is a change in beneficiaries that you want, change in your own wealth position, change in your family constitution, and all those things. So with this, I would like to end my presentation and wishing everybody a very proactive succession planning after we are free from our July hectic season of our client work. Thank you so much.
Thank you, madam. Can we take one or two questions?
Yeah.
Yeah. So you mentioned that in a probate, everything is quite open, and the court gives an opportunity to the other heirs also. So in this case, there's a possibility of dispute. So what would you still recommend? Should one opt for probate where it is not mandatory?
So there is no requirement to go for probate where it is not mandatory. But the biggest challenge is if you go to a bank will say, give me a probated will if you want to open an estate account. Some societies insist on a probated will to transfer your asset to the legal heirs. Now, while you can fight with them legally, but practically, you want your work done. At the end of the day, the assets have to transfer to the beneficiaries and not spend time in court. So you will have to take a very practical call. So if all your transfers are happening seamlessly, there is no need to go for a probate. But our experience is that after having transferred 90% of the assets, my 10% of the assets in the example where I want to transfer it overseas, now I am forced to go for probate because I cannot open a bank account of the estate without a probated copy of the will. So it is a very practical call which you will have to take depending on what is the asset involved and whether the agencies that are involved are insisting on a probated.
Okay. Another question is, I think you mentioned that the will should be periodically reviewed. And you also mentioned about a residuary clause. So is the residuary clause enough, or you need to be periodically reviewing, probably say maybe what
So,
you also.
like for important events, like for example, you made a will when you were 25 or 30, maybe. You did not have your own house. At 35, now you're owner of a valuable house.
Hmm.
There is no point in not mentioning that in your will because that is a very important asset class. And it could be that you are sitting on an FD of 50 lakhs, which now is converted into a residential house.
Correct.
Your decision of whom you want to give a residential house will be very different from whom you want to give 50 lakhs of rupees. You had mentioned somebody as a beneficiary, but he unfortunately passes away before you have passed on. So there are important events in your life, financial events, personal events, which will require you to revisit. So if you were not married when you made a will, now you are married, it is mandatory to change your will.
Hmm.
So
Right.
there are circumstances which are very important. So if you are making your will at the age of 80, you may not need to revise because your facts are not going to change materially. Your
Correct.
sons were married that point of time, they were settled, you were clear what you want to give. Even at 85 you're alive, you don't need to revisit the will. So everything will depend on when you made the will, what are the changes in circumstances and facts after that.
So on behalf of the committee and on behalf of the participants, it is my honor to present a vote of thanks to you, a very talented speaker. The session was truly insightful and enlightening as you travel through the various, not only the technical aspects, but also the practical aspects and the practical reality of estate and succession planning. Truly, knowledge is the supreme wealth. So succession plan, knowledge about succession planning that you have imparted to us is really valuable, and we thank you for your time and efforts from your busy schedule that you've imparted towards us. Request the audience to carry this heartfelt vote of thanks through by with a virtual applause. And I now hand over the proceedings to Shreya for introduction of the next speaker. Thank you. Thank you, madam.
Thank you, Riddhi. So moving to our next session on non-profit organizations, various statutory obligations. So I'm really glad to introduce our next speaker, C.A. Subhashini Ganpate. C.A. Subhashini Ganpati is the founder partner of Subhashini and Associates LLP. She is a specialist in direct, indirect, and international tax. She is also a qualified forensic auditor. She is accredited faculty by ICI Ministry of Skill Development on GST. She has also been a part of various initiatives in GST awareness by Tamil Nadu government and ICT Academy. She is a member of DTRTI and has trained many officials of tax department. She has led a team in unearthing a fraud of 30 crore in an institution in forensic audit assignment. She has been co-opted as a member of research committee of the Southern India Regional Council of ICI. She has been a co-opted member of SICASA of ICI, also committee member of Society of Auditors, MyPlot. She has started a YouTube channel named Red Pigs for educating and creating awareness in the general public, and she has received viewership of 5 lakhs on one of her video. With this brief introduction, I welcome C.A. Suhasini Ganpate. Handing over to you, ma'am.
Thank you so much. So, Shreya was very, very generous in introducing. I think she did not miss a word in her profile. Thank you so much. And as far as charitable organizations and its compliances are concerned, I understand that there was a session on the income tax perspective of the charitable organizations very recently. So I'm not touching anything on the income tax exemptions or so, but again, like any session would be incomplete without a touch of the income tax, because the very effect of charity or running a non-profit organization, the cherry which everybody looks at is the income tax exemption which they enjoy on the revenue which they get. So having said that, let us just look at the origin of this charitable organizations and the respective acts. So charity probably like today, as all of us know, since 2020 has gained so much of importance. That too with the development, the rapid development, if I may say so, with all the Atmanirbhar Bharat and so many other initiatives by the government. So it's a kind of massive development which is going on in the country, and with the uh, a proud boast of very high demographic dividend, it is important that we actually pull up the economy, do that heavy lifting in terms of the economy, to actually make the best use of the resources, the human resources, and of course, like all other resources in our country, to for the overall development, for the holistic development. But having said that, doesn't mean that the government can do all of these. The answer is a big no. So what can the government do? So there are so much to do, maybe like rural development, electrification, education of the poor, upliftment of the poor, education of everybody, not just the poor. So upliftment of the poor, women empowerment, so many factors, and we still have villages which are completely underdeveloped. So starting from pre-independence, where people came to invade India, and post independence over a 7 decade time period where India has faced so many different challenges in terms of growth, and thanks to all the changes that wherever we are today. So, and as part of the growth in this 6 decades, I think there was a clear demarcation of the development where the development meant a different uh, thing to a city, a different thing to a urban place, a different thing to a region, a sub-region, and so on and so forth. So development, there was a clear demarcation of development, and there was like differences in the developing country. But a country cannot develop like that. It has to be a holistic development to call it the real development. But how can this actually happen? So the government has to co-opt people, like what we do as there's a women members empowerment committee, and it's like for the women, by the women, and of the women. So here, what do we do? So we spend our time in terms of professional engagements. So what do we do? We either in the professional front or in the personal front, we just co-opt people to get things done. So that's a way things can be managed. And similarly, like government also co-opt people to manage the activities, the Herculean task of developing the entire country holistically. So but I mean, is it anything like results will not really matter until it is truly measured? So, how do we measure the development? How do we actually measure the return on investment? Probably the language which all of us understand. So, there's so much of tax exemption which is given to the trusts. There's so much of corpus being accumulated for which again permission is given legally. There's so much of donations which are flowing in locally and internationally into the trust. So, with all the permissions, exemptions, and exemptions are enjoyed by the donors as well. Giving all this, are we really getting the required return on investment on the at least the foregoing the tax perspective, and all the benefits the people enjoy? So, since like 2008, the government has been slowly studying the development. There are like various reports in terms of the CSR activity, in terms of the companies investing in CSR, in terms of the societies where largely like now I think I belong to Tamil Nadu, and now it is all online. But until recently, until the last 2 years, it was only paperwork. So similarly, like the states wherever you belong to, it could be manual or it could be electronic that way. So consolidating and getting data are subject to again typographical errors, subject to availability of papers, and submission of returns. So many other factors, because today like online MCA, if we don't file a return, it's like just one click you're able to see like what are the forms which company has not filed, and what is the penalty, etc. So it isn't all that easy to measure the result of a charitable organization. But having said that, with whatever little information the government has been getting, the return on investment it has not been so very satisfactory. So what do we do? So when there is some deviation, immediately a kind of regulation comes in. And this regulation, again, I would not just say like it came in 2020. So we had it uh, pre-independence era, even in the 18th century, Societies Registration Act 1860, which even today many of the states follow. The Religious Endowment Act 1863, the Indian Trust Act 1882. See, I'm talking about the acts which are valid even today, and there is no replacement. And in Tamil Nadu specifically, we had a Tamil Nadu regulation bill again in 2020, but that actually had it life only as a bill. It was never passed as an act. And few states have their local trust acts, and others are actually related to this Trust Act 1882. The Charitable Endowments Act 1890 protected institutions in terms of in respect of their income and property. So all these acts actually protected the uh, income of the trust and their activities. It also regulated their activities, streamlined, and so that like there is seamless flow of the intent and the action. So, but having said that, like for some reason, I think we'll have to accept that the moral kind of value systems in terms of corporate governance, or be it ethics, or be it the small moral values, are diminishing. So it's a very hard fact which all of us have to accept. So that again is diminishing, and therefore the regulations, the conditions, the punishments are all increasing. So that somewhere we'll have to strike a balance to bring in those moral values, which actually is the core essence of our country, or core essence of any activity, any act that way. So as mentioned, like in the earlier years in 1860, 63, 1882, the regulations weren't so much. So it was like very liberal. The British government later introduced two more enactments, which is Charitable and Religious Trust Act 1920 and the Trade Unions Act 1926. Trade union, of course, like was never considered as a charity as such. The Income Tax Act, of course, was introduced in 1860 and in 1922. The government granted deduction from income to individuals on donations for charitable purposes. So 1922 is when we actually started getting deduction benefits, and of course, like 1961, granted exemptions under section 1022, 1023, 11, etc., etc. So this charitable organizations trust, as such, like there are around 30 to 35 sections which are relevant in taxing the charitable trust. I mean, more of regulations, and direct tax amendment act in 1987 omitted 11, 12, 12A, 13, and new section 80F was inserted. Then again there was representations in 89, and again like there were amendments in 51 amendments, in fact, like in section 11, 13, and 110 amendments in 215, 8 amendments from 1975 till date. So these numbers are mind-boggling. So why actually like there should be so much of amendments in terms of this charitable organizations? After all, they are doing charity, and it is for the benefit of the people. And as far as charity is concerned, all of us feel that it is not done for profit. Of course, the name itself implies that these are non-profit organizations. So they are, of course, non-profit organizations, but is it really non-remunerative organizations? So the government is so demanding, the country is so demanding, the globe is so demanding that the non-profit organization sector has to bring in so much of development, has to supplement the government activities in terms of development of the state, the development of the village, in bringing in the kind of holistic development of the country. If it is so demanding, then it definitely requires that kind of skill and energy to bring in that kind of results. So the return on investments can be as effective as expected only when there is that amount of resources which is actually deployed there. But the way the taxpayer is hard, legislature does not really go to make it any easier, because like the simple fact that demands are high, the expectations from the non-profit organizations, the charitable institutions are very, very high because they play a very, very vital, crucial role in terms of the development of the country, in places where the government cannot reach. Probably like the government's hands are so full that it has so many other things to look at. There are so many areas where the government, even the local panchayat body, does not penetrate, or the kind of schemes does not actually reach. Of course, with the other link and all that, we are heading towards that. But having said that, there's definitely a gap all of us must accept. And the true kind of resilient economy can flourish only with the support of the non-profit organizations. So when we say this non-profit organizations are so important, and there are like so much of expectations from the non-profit organizations, I think it is important that the non-profit organizations realize their role and be very, very self-regulatory and all that. As we all agree that the self-regulation probably is not the mantra of the hour in terms of people, and we have very high resources, definitely are demanding. Though the OECD, the Organization for Economic Cooperation and Development, rolls out this mantra of voluntary compliance for any developing country. So make compliance easy and make non-compliance very, very difficult. Though on one end, be it Companies Act, be it GST, be it any other law, Income Tax Act, or any other law for that matter, government insists on voluntary compliance. But voluntary compliance is filing your income tax returns, and this AISTIs and your 26As is like, hey, come on, if you don't disclose, then we know it. So that kind of moral policing actually helps in this voluntary compliance, so that making non-compliance easy becomes justified for any government, and I think that's what this government is also doing. So here, in terms of this charitable activity, it's important that the true charitable activity is performed to align the objectives with the government, and giving so much of benefits to the non-profit organizations to manage, and so much of responsibility to the non-profit organizations. I think the compliance, the government has zero tolerance towards any kind of non-compliance. So when we're talking about the zero tolerance towards any non-compliance, as we were talking about the number of acts which govern the charitable organizations, we don't really bother about any other act. So it's not right to say so, but let's be practical and say like we are not bothered about the Societies Registration Act or the Trust Act. Any small non-compliance also will of course attract penalty, like we'll have to pay the penalty and get things done. All that is fine, but any non-compliance in Income Tax Act, I think now all of us would have got notices for our trusts for delayed filing of 10B last year, the audit report for trust. And we also received a condemnation. The condemnation was such a big relief to all of us. Thank God. Otherwise, like the trust would have lost their essence of exemption. So it is that dangerous that the entire amount will go as taxed. So here, non-compliance, does it really mean only non-compliance with Income Tax Act? The answer is a big no. Because in October 2014, if I remember right, there was a added ground for cancellation of 12A, and in 2019, actually, it was brought in that the commissioner should check the compliance of all other laws to ensure this income tax exemption is intact. So today, with all the re-registration process on where the government wanted to clean up, looking at the statistics of the income deployed, the return on investments, the kind of changes which has happened in the charitable arena, all this, the government said, okay, fine, if you're actually compliant, then come to us. So we will start screening you. If you are non-compliant, better stay away. So this was the reason for the amendments in 2020, which brought in the re-registration in total. And this re-registration was such a simple process, and all of us would have gone through it. But having said this, re-registration as a simple process, and all of us have our 10 AC in hand with a provisional or permanent for 5 years, whatever, 3 year, 5 year period. It is a we'll have to be cautious that we are under scanner, a serious scanner, because it was difficult for the government to come and monitor all the charitable organizations, given the kind of so much of data which the government was not able to pull out where the problem was. There were like number of trusts, number of organizations which were filing the returns, and I will just take you through some statistics. Share my screen. So budget 2020, this is something which is important, which comes in every budget, but 2020 gains importance because that is where this the change of the re-registration, etc., came in, and they've said that aspirational India is like it has to boost the standard of living, caring society, and economic development was for all was the mantra. And while the finance minister duly acknowledged the contribution by the charitable organizations, she also said that the governing applicability of the charitable organizations will be changed, and the disappointment with all the malpractices which were occurring in around the charitable organizations was clearly mentioned. So here is the money laundering which happens through the trusts. So a few religious education trusts are being used to launder black money. So it is like very careful when we are using a few, because again, having said that, charitable organizations are doing so much, and their contribution to the country cannot definitely be discounted. While we say a few organizations, just like everywhere, every profession, every place, there are a few people who misuse. So, but the problem is like, what is the impact of those few? So just like our own fellow community, where the chartered accountant community, where we feel that a few chartered accountants actions are impacting very highly, like very high impact on all the 3 lakh chartered accountants who are doing genuine task, taking this profession as a passion, etc. So similarly, the few trusts, I'm very careful in calling it a few trusts. So this is the cycle which happens. A person donates 1 crore to a charitable trust running an educational institution. Trust buys a luxury car in its own name, and the car is being used by the donor for personal use. So what happens if the donor buys a car in his own name? Again, forces, uh, etc. There are so many other issues here. And again, like this is a very clear route of converting your unaccounted money into accounted money. And religious trust, again, like if this can happen in a if it's in a religious trust, they can buy some property, a commercial complex, maybe a kind of place which the religious institution owns. Then that can be given free of charge or as a very, very nominal rent to the trustees, and they can go on. So these kind of money laundering activities were going around the trust, and this is actually the outcome of the study which the government did. Government has been doing since a decade, and this 2020 change did not come in one day. So there's been a lot of effort which has gone into this. The gross income of the trust, if we look at 13-14, it was like 3.1 lakh crore. In 16-17, it was 5 lakh crores. And today, if you see, it will be like manifold. And tax returns filed by the trust. This is like charitable trust and the other trust. So here the charitable trusts, if you look at the numbers, from 70,000, it is actually increasing to 1,10,000. Others, if you look at from 1,05,000, it is decreasing to 42,000. So this composition actually was a little troublesome because this private trust, the charitable trust, again, when we look at what is charity, that's a big topic altogether. So this advancement of general public utility becomes the key element of charity. So we have different definitions worldwide, different case laws, which says that it is the onus is on the trust, of course, to prove what is actually charity. So the objectives of the charity and what is demarcated, what has the trustees foregone to take the property to put the property into charity. So all these things are like a number of case laws. In fact, like we all say, like we'll have to make a living. So you make a living by doing some profession, and you make a life by doing charity. Now there are like Dharma Prasad and the case laws in Kerala. So there were like three case laws which actually came in favor of the SSE, which said they were running chit business, earning money, but they did not make profit out of it. So they were making the living. So they earned money. So it's like you either do charity by collecting from people, or you do charity by doing some business. So they were doing chit business. They were collecting money, and this money was deployed for charitable purpose. They did not take any personal benefit out of the business. And uh, believe me, the government gave in, the court actually was in favor of the SSE, which said like, though they have done the business, the deployment of that money actually has gone into charity. So we need to give them that benefit. So when we look at the charity, what is charity and whether it is defined, etc., like, that's a different topic altogether. Not going detailed into that. So here, origin of the trust regulations in India, we just saw like there were lots of trusts and constitution versus statute compliance. So here today we have like the non-profit organizations. If we just put it in quote and quotes, there are like yeah, as far as trust, company, and a society. If we can just put this into three different buckets, and of course the everything is tied into one single thread, which is the Income Tax Act. So whether you fall into any of these buckets, the key essence of following into these elements, registering, keeping your trust deed, giving importance to every clause, sticking into the main objectives, whatever you do in all these three acts are for the Parabrahma. It is for the Income Tax Act exemption. So if only like there weren't any income tax exemption, then charity will be like, you just do the charity and continue with whatever you are doing. So only because there is an income tax exemption for the trust and for the donor, it attracts so much of importance. And that is again the double-edged sword, where it demands so much of compliance from the non-profit organizations in terms of Income Tax Act, not limited to income tax alone. It is actually for any other law. So any non-compliance under any law will definitely impact your income tax exemption is the message we all have to keep in mind today. So having said that, the three different buckets which the non-profit organizations fall in are like, if you are a trust, then Indian Trust Act 1882 or Tamil Nadu Public Trust Act 1961 and Income Tax Act 1961. Similarly, if you're a company, then the Companies Act 2013. And if you're a society, Societies Registration Act 1860. And if you have your local laws, then those, and of course the Income Tax Act. So here, if we look at the societies as a glimpse, the charitable purpose which came within the the charitable purpose which came within the language and spirit of the Statute of Elizabeth. So this was like the initial days, the reason for this act to come in could be grouped into four heads: relief of poverty, education, advancement of religion, other purposes beneficial to the community, not coming under any of the preceding head. And of course, like advancement of religion is slowly going away, wading away, because that is no more a part of charity. The words, of course, like having said that, there are many case laws which also sees like religious activity can do charity and nothing stops, of course. And the words in the Act 21, 1860 are therefore to be understood as including religious purposes also. So this was one change which has happened over the years. Hindu public with this is Rajdhani Puja Samiti, AR 1999 Supreme Court. So here, if we look at glimpse of the compliances in terms of the charitable organizations, companies is a different topic altogether, which I have in the forthcoming slides. So the applicability is of the society is all over India with state amendments. So in 1975, of course, is exclusively for Tamil Nadu. So if we have a registration is not mandatory there, it is compulsory in certain cases. Of course, like now, keeping aside the Societies Act or the Trust Act or the Companies Act, of course, we don't have options as to whether we can register or not register or do away with it. So we have to get ourselves registered to get exemption under Section 12AB of the Income Tax Act. So for registration under Section 12AB, you must be a registered institution, and that registration document is mandatory. And this excludes so if you have economic conditions, no club where games or chants, etc. So there are so many clubs which is created for recreation. So all those things are out of the ambit of charity, and it includes religious, and 1975 does not include religious. And again, like after post registration is possible, here it is not possible. Annual compliance is mandatory in both the acts. Penalties are equally applicable. Name restrictions is not applicable, and but here it is applicable. So compliance according to 1975 Act, and this is common to all states and the center. So the accounts and audit, application of funds, investment of funds, maintenance of records, conduct of meetings and related returns, submitting returns. So this is actually society. Probably we can extrapolate this to the company also. So for a Section 8 company which is registered under Companies Act 2013, we pretty well have all these compliances. Accounts and audit has to be done. Your application of funds has to be judiciously done with prudence. Investment of funds, of course, like Section 11(5). Maintenance of records is important. And conduct of meetings and related returns, no decision can be made with monopoly. So it has to be a democratic decision. So the completely like all your decision pertaining to the charitable activity, be it your collection of donations, be it your application of funds, be it your investments, be it your donation which you're doing maybe to another organization, everything has to be minuted and it has to be a collective decision. And for the simple reason that any trust cannot operate singly. So submitting returns again. So there's a small statistics of the societies. So where I was mentioning about the collection of data by the government. So the government tried collecting data. So distribution of societies registered in different periods by location. So 1970 and before, this is like all over India. So rural, urban, and the total. So if we look at series, like it has been growing all through. So this only says that there is growth of lot of charitable organizations where anybody and everybody, even if it is a very, very small trust, even if you want to family kind of a trust, where everybody keeps helping. So they want somebody reliable who can actually look at the true need support. Then I think every family, every place, like they start a trust and put their funds into it and they start donating. So the number of non-profit organizations are pretty well increasing. But again, if we compare the slide with the earlier slide, which we saw, the amount which is deployed, the number of returns which is being filed, and the accumulated reserves, where the actual application is more than the actual accumulation. All these are giving a sign there is like total mismatch, and this particular segment of non-profit organizations is completely unregulated. So this calls for regulation of the non-profit organizations, and that is why the re-registration actually has come in. And having done the re-registration, I think we'll have to be very, very careful in complying with all other laws applicable. So when we say all other laws, it is in essence and spirit all other laws. It could be your society, it could be your trust, it could be your company, it could be your labor laws, it could be your fire safety license, it could be your FSSAI, it could be any other laws applicable. Any violation under any law or any disobedience in terms of any court decree, order, law, rules, regulations, etc., will tantamount to cancellation of our essence of the non-profit organizations under the Income Tax Act. So multi-state societies will propose, and the constitutionalities for questions. So let's move on to the trust. I think I'll have another 10 minutes. So the trust actually, like 1882 and 1920 comparison, the whole of India except Jammu and Kashmir, of course, like And this amendments actually included Jammu and Kashmir, probably like our GST, where slowly it was extended there as well. And the purpose actually, like it is charitable and religious, of course, had a lot of uh, probably like disputes. And what is charitable is like advancement of general public utility. So it could be relief for poor and all that. So of course, like our 215 gives a detailed definition of what a charity is. So when we borrow this from the Western world, the word public is missing there. So we will not have the word public. So any utility for the general, any utility in general will be a charity. But here in India, the constitution was very being inserted. That's why advancement of any public utility becomes important. Income tax amendment, it is incomplete. Any presentation is incomplete without the mention of the income tax. The trust regulations prior and post transaction. So it is like the mandatory registration validity, new registration, cash donations up to 10,000 now, which is 2,000. So again, like this cash donations for this 2,000, etc. We have ample case laws to say like there was a medical college which was built and there was like a lot of cash expenditure. And finally, like the court ruled just because complying with all other conditions, just because they spent this money in cash, the exemptions cannot be denied. And similarly, like there were like so many other case laws where there were like Section 13 violation of many other provisions. We did have case laws which said like violating any single provision cannot deny the entire exemption itself. Rather than probably you can add it back, disallow, and tax the charitable organizations, but the entire exemption itself cannot be denied. And this is something which all of us know. So it's like the 3-year validity, and we have to go in for re-registration in the last 6 months. So for all the trusts, we have got this registration as provisional, 10 AZ as provisional. Our trust is valid for next 3 years, and you can actually go in for the permanent registration the moment you start your activity or at the end of 2.5 years. So this 2.5 year period is the time for screening where we will be under close watch. So any non-compliance under any law will attract cancellation of our registration. And 10.3C, all this I think is covered. FCRA, we'll move to FCRA. And before moving to FCRA, I think it is important that we look at the trust deed and pointers which we have to be compliant about. So, looking at a trust deed or a society's bylaw or a company's memorandum of association, a company's primary document, it is important that the trustees are still alive. Of course, like all of us would have done this exercise when we were doing this re-registration. But we also hear so many people saying that since it was an automatic registration, I just uploaded some file and it got approved. So, and the government did not have so much of bandwidth to collect the data, screen everybody, put everybody into the scanner, scrutinize everybody to check whether everybody is correct or incorrect. So they just did one mechanism, like all of you go out of the registration. We are completely cancelling the exemption once for all. And if you wish, if you think that you are genuine, if you think that you can be compliant, if you think that you can abide by the law, and if you think that you can truly contribute to the society, then come to us. We'll start screening you and we'll keep monitoring you. So the important key elements that a trust deed has to contain: the name of the trustees. There may be situations where somebody started this trust and they are no more, but the trust will still be functioning. Maybe somebody started this trust for relief of maybe like children education, to put it that way. So because like 2-3 decades ago, it was the children who were affected, but today it is the ulta. It is like the parents, the elders are affected. So today there is need for more old age homes than the orphanage or childcare homes, because like fertility issues and other things. Once on the scientific side, there are so many issues. And the other way around, we are also getting away from the general moral regulations, the culture essence of India. So there, it requires a lot of support for the old age home. So nothing wrong. Both will fit under the charitable activity, and charitable activity should be for the general public utility. There are two exceptions to it. If you are doing this specifically for women empowerment or children, this can happen, or specifically for the backward community, this is possible that you can do it this do it in such a way that the benefit is flowing to that particular specified community. So it's either the women community or so. So as I was mentioning, like a trust was started, and maybe they were doing childcare activities. A couple of decades later, today they feel that the old age is important. So they have converted their space to accommodate the elderly people, and they're doing it here. So nothing wrong actually. So they are still sticking on to their objectives. But if their primary objectives were this, and maybe if they did not have any mention about the elderly care, then it is important that the trust deed is amended to that effect. And with all the changes, any changes like this is nothing new. Of course, we had it earlier. Any amendment in your trustee can happen only with the permission of the commissioner. So we had challenges when doing the re-registration. We did not have all the time to take the permission from the commissioner. So probably like the practical solution many of us would have followed is we did submit that. We submitted the acknowledgement along with this amendment deed while getting our 10AC. So when we get an opportunity for hearing, we can actually explain the challenges we faced, why we could not get a permission from the commissioner. So coming back to the trustee, the essence, it is important that the trustees are alive and active contributories to the trust, because Section 13 revolves around the trustees, and the KYC of the trustees, despite the ruling from the Supreme Court in terms of privacy breach, in terms of asking for your passport, in terms of asking for your Aadhaar, etc. This still holds good in terms of even your registration with FCRA, where we do the registration of all the trustees. So that is nowhere in the Act, but still, like, you get of the trustees because that is mandatory for you to do. So the trustees are being monitored, and your place of business. So now probably like in the Companies Act, we do have all your you take pictures of your board, your place, your latitude, longitude, etc., and we submit. And that is one reason where the government has brought in the CSR regulation and the CSR forms, where you need to have. So it is probably like a challenge to actually regulate the trust and the societies. But they said, like, if you are using CSR funds, because CSR funds are the true source for the development of the country. And if you're using CSR funds, then come to our regulation, file the forms with us, and come into the regulation so that we can monitor you easily. So the compliance, your address, and the activity, and the objective, including the signing authorities and the next generation succession planning, is what beautifully told ma'am was taking. So succession for the trust is as important as we for our family, because the signing authority, the appointment, etc., is very, very crucial. And believe me, you will not be able to do any kind of compliance if these things are not in place. So it is important that we do our homework in putting these things in place to ensure that we are compliant with all other laws to continue to enjoy the exemption under the Income Tax Act. So when we're talking about trustees, FCRA Amendment Act has brought a restriction that 3(1)(c) public servant cannot be a trustee, a judge cannot be a trustee, a government servant or an employee of any corporation or any other body controlled or owned by the government. So any person related to the government cannot be a trustee if you are a trust enjoying the FCRA exemptions. And restriction in transfer of funds. So one FCRA fund, FCRA trust cannot transfer to another FCRA trust. So earlier this was permitted. So I have an FCRA registration. If I am receiving something from abroad, I can actually transfer this to another FCRA approved trust. So I cannot transfer to any other trust, which was not allowed even earlier, but I was allowed. Today, this is also banned. And the administrative expenses is brought down to 20%. Similarly, for CSR, we have a restriction of 5% of the administrative expenses. Basically, because if you can relate to our second slide number 2, where the money laundering activity, people were enjoying luxurious royal lives calling themselves as, the trustees, the non-profit organizations, as they were doing voluntary service. They were enjoying better salaries than the people who toil in the corporate world. Having said that, it is important that we have quality resources, we pay them well, so that the co-option mechanism, the deployment of CSR is effective. And when we say this administrative expenses is 20%, it is the core administrative expenses and not even related to your projects. And any contraventions of the provisions will be considered as additional contribution. And bank account, of course, all of us would have done. And for the first time, they have said like you can voluntarily go and surrender your FCRA. And the officer also can suspend your FCRA for 6 months. And if required, if it is suspicious, they can continue to do so for another 6 months. Of course, the renewal and the bank account, all of us know. So it is time to evaluate our compliances in terms of all other acts. If it is either stamp duty in terms of I am just taking you through a quick slide where the compliances under each activities, the statutory obligations which we have to do. So your annual returns and what are the contents which has to go through in terms of the stamp duty. Society, there's no stamp duty. Trust, there is stamp duty. Section 8 company, again, we pay online to the Ministry of Corporate Affairs. Members requirement is again 2, 7 and 2 for otherwise. Board members governed by the trustees and both. I think that is applicable to all the entities. Revocable, irrevocable. Here it could be anything. It can be dissolved. But for 12A things, you need to have a clause as irrevocable. But even if it irrevocable is mandatory, and dissolution, of course, is possible, provided like you have a succession plan. So today I have a trust, and we need to know like what will happen to this trust, the assets accumulated, the funds accumulated in the trust. If it is being donated to another trust having a similar objective, it's perfectly okay. Annual compliance, of course, all of us know. Registration is in par. It's like the same for everybody. As far as subsidy to the government, if it is a company, it is most preferred. If it is FCRA, or if a company, if it is more preferred. Transparency in working, again, like if it is a company, the compliances are higher. That's where you earn that credibility. Change in board of members, it's easy in terms of a company where you'll have to file forms and of course with the resolutions. Change of registered office, it's easy there. So probably like if we can go through the company's compliances in terms of the statutory angle, I think we will all agree that the compliances is made easy and the non-compliance is made difficult. So if you are compliant and any change, any effect which you want to bring into the trust is actually easy. Online filing facility, of course, society today in Tamil Nadu, it is there. I leave it to the members to check their respective states. So inactivity, of course, like you'll have to have a clear succession planning on what it is. And procedure for conversion of trust into a Section 8 company, I thought I can take if we have time. I think I've already exceeded. So thank you so much for the patient listening. And it's important that we are compliant in terms of law, especially when we are managing non-profit organizations, because the government has zero tolerance towards any non-compliance, simply for the reason that it gives so much of benefits. And today, non-compliance is costly in terms of even for the MSMEs, even for the corporates, even for the individuals. So we are all running against time in terms of 31st July returns. So earlier we were like, okay, fine, 31st July, we'll have March, or if it's just a penalty, it's okay. But today we all have the fear that it has to be done before 31st July. If that is the state for a normal individual, for a non-profit organizations enjoying so much of benefit, the government has brought in so much of regulations. But again, the compliance is easy if it is done in a planned, phased manner. Thank you so much for the patient listening. And I sincerely thank the WMAC for this wonderful initiative and the wonderful opportunity given to me to share my ideas with all learned gathering. Thank you.
Thank you, Subhashini ma'am. Let me take this privilege to offer you a vote of thanks on behalf of the committee as well as the participants. It was truly an interesting and insightful session as you charted through the various statutory compliances, and as you repeatedly mentioned that compliance is important, and I totally agree with you. As you charter through the various list of statutory obligations under various acts, specifically with reference to Trust Deed, Income Tax Act, Societies Registration Act, Indian Trust Act, and FCRA. With your session, I think we are also looking at, with your session and with your knowledge, we are also looking at ease of doing charity in addition to ease of doing business. So thank you very much for your relevant session. I also thank all the participants for gracing the session with their presence on behalf of the committee and the speakers. Thank you. I now hand it over to the technical team to close the session.